G'day everyone, welcome to this first global update for 2015, and since the 1st of January the notable feature of not only stocks but also currencies and also bond markets as well has just been extraordinary volatility, and there's just so many things at the moment that are causing the market to be unsettled. Throughout 2014 we saw a continuation of the very severe falls in coal and iron ore. That was joined by oil over the last 6 months, and we've seen those just extraordinary moves in oil. And then we've seen copper also break down, and now, of course, massive currency moves with the decision by the Swiss National Bank just a couple of days ago. And all of this is contributing to an enormous amount of uncertainty, an enormous amount of volatility and nervousness. A lot of people have just basically moved to the sidelines. So there's a lot of selling going on that is not natural. It's not part of the normal process of buying and selling on value. It's just a real pullback, and people don't know where markets are going. So I think volatility is going to continue to be a feature, and I've been saying that for 6 months, that 2015 would see a significant spike up in volatility, and it's certainly started that way already. So let's have a look at the various markets that we follow. The S&P 500 index ended up down 26 points on the week, and as I said, there's just so many big moves in commodities and currencies that it's impossible to predict how they're all going to play out. But I can tell you that they will take quite a few months to play out. There'll be things occurring in a few months' time which is not an immediate reaction but are a consequence of what's going on right now. So medium to longer term, the American market still looks very appealing to me. I know there's plenty of people out there that want to tell you that the American market's overvalued and it's going to crash. It's just sensationalism. I don't know, it's people just being stupid. The medium term in America still looks reasonably appealing. However, the way that markets are and the way that some sectors of the American market are, you can still get yourself into trouble unless you know what you're doing. So you still need to exhibit patience and care even with the American market. But to me, it's the American economy is in the best shape of anywhere around the world, and the American stock market is going to be the most reliable. Now 1820 is an absolute key support to keep this bull market alive, but that's a fair way down from where we are now. So let's have a look at the S&P 500 chart, and you can see that basically through 2012 and 13 and 14 we had this terrific run. From the far left side here, we only had one very brief excursion below the red 150-day moving average line that occurred in November of 2012, and apart from that, the market index stayed above that 150-day moving average, which is I find a very, very useful broad indicator. Now, for the first time, it dropped below that level, and quite sharply, in October, so only 3 months ago, but quickly rebounded. Now, this sort of behavior is the sort of thing that you start to see as markets start to form a top. The character of the market has changed. We've not seen a dip below the 150-day for nearly 3 years. So there's no question in my mind that the character of the American market is starting to change. But that doesn't mean that it's going to go into a decline now. It could be a year, it could be 2 years that this process takes to play out. And the American market, based on valuation, still could move to a new all-time high. On some of the valuations that I've done, I could see the S&P index being up in the 2,200 to 2,300 point range. So it's just something to be aware of, that the market is now more volatile. You can see, if you look at the daily ranges of these candles, the top to bottom ranges, they're much bigger than back here. So the intraday moves are much more volatile than they were. So it was a pretty negative week. We had 5 sessions down in a row in America, but finally on Friday the market did find a little bit of support and moved back up again. So 1820, if this level here at 1820 were to break, then I would say we're now into a bear market. But that's a fair way down. There's a lot of things could happen first. If we get a little bit further decline down into the 1950 area, possibly even 1920, I'm still okay with that. But anything below 1920, I'd start to get a bit nervous. And of course, anything below 1820, I'd be throwing in the towel as far as stocks were concerned for the time being. But we want to be well and truly clear of the market by the time the market got to that level. Now, looking at the Australian market, the ASX 200, it was a big down week. Every session was down, and we ended up down 166 points, and it was across the board. The banks, the major miners, healthcare stocks. About the only stock that fared okay that I can see of significance was Telstra, and Telstra had a pretty good week. So this was the worst performance, lost a little bit more than 3%, the worst performance in nearly 2 years on the Australian market. And it's pretty hard to see what's going to change the local sentiment here. Our economy's not great. All of our reliable high growth stocks are fully valued to overvalued. So it's pretty hard to see them going up much. The banks are certainly fully valued. And you could argue they're overvalued, so it's pretty hard to see what's going to change. I think the only way you can make headway in the Australian market is just to be very patient and just buy when you get a good edge in the best growth stocks when they pull back sharply. And I think that's the only way to play the Australian market that makes sense at the moment. So let's have a look at that index just for the exercise, so you can see we've really been tracking sideways now. Well, it's probably really since the market has trended. You've really got to go back to October of 2013. So it's about 15 months since the market has really trended in Australia. And when you consider that the banks certainly went up during most of that period, you know that the rest of the market has been pretty sad. But look, the ASX 200, it's just really struggling at the moment. Now, moving on to gold. All the other commodities are being absolutely smashed, but gold managed to gain $57 on the week, and whilst it's not out of the woods yet, it's certainly looking a lot more positive. So for me, I think this could be interpreted possibly as the first leg up in a 3-year to 5-year bull market. Now, I'm not saying that is the case yet, but it's now distinctly possible that that is an outcome that we could have. There's a classic technical pattern, which I'll get to in just a minute, which is now complete, that would support that view that we're in the first leg of a major multi-year bull market in gold. And history would show that if that is the case, if that technical pattern does follow through, history shows that on average we could expect something like a 33% advance over the next 3 to 6 months. That would be normal for the first leg of a new bull market. Now, that means we're talking something of the order of $400 an ounce in the gold price. That takes you up towards $1,600, $1,700. That would be normal for the start of a new bull market. Now, let me just repeat again, I'm not saying that we are going into a new bull market. I'm just saying that it's at least a 50% possibility at this stage. However, before we get into the major advance tends to occur in wave 3. You've got to expect a bit of a pullback. So you want to be careful about buying just yet. The best time to be buying gold stocks is when gold has gone up, pulls back, and then finds some stability. That could be several months away yet. So that would be the best time to be buying into gold stocks. However, the other alternative is this could just be a rally within an overall bear market that started 3 years ago. To determine which one's which, I'd like to see a break above 1,300. That would be the key for me. So let's have a look at the gold chart. Look first of all at a weekly chart. So you can see here that we've had a declining wedge. We got a break of that support at around 1,200. It went down about $50, $60 below that support, but false breaks are not unusual. And with such a robust move back into this declining wedge pattern, it's quite possible that this was the final last gasp false break to basically clear out the market, run a few stops, and now the market has turned around and the big money players have moved back in. And you can see the last 2 weeks the gold price has moved up quite sharply indeed. It's up more than $100 an ounce. Let's zoom in a little bit and look at the daily chart. So this is the daily chart, shows you a little more clearly. We had a low here in 2013, another lows again at the end of 2013, another one in October, and then we got a false break, and now we're moving back up again. So we really need to get outside this trend line, which is around about somewhere above 1300. I would start to feel a little bit more positive, because then that would be a change in character. Up until that point, we've continued to have lower highs all the way through. If we can get up above 1300 or even 1340, which takes us above this little peak here, then I think that you'd say that is definitely a change in character in the nature of the price of gold. Now, however, we do know that gold stocks do move in advance, and we're seeing that happen, and that adds further weight to the fact that we could be on the start of a new, finally after 3 years, the start of a new bull market. This is the GDX index, the major gold miners, and you can see we've now formed a higher high and a higher low. So certainly the GDX index is looking more positive now. So certainly some reasonably good signs in the gold market. Copper, spoke about this for probably 4 months ago. I said the $3 support level looked very shaky, and it broke that support a couple of months ago, but then just hung around between $2.90 and $3. But then finally all the support gave way, and copper crashed down to $2.61. So it's joined in with all the other commodities. And with copper going into such a decline, that's a very bad sign for the global economy. So that's not good, and that does disturb me, the fact that copper has crashed. We'll have a look at the copper chart in just a minute, but West Texas Intermediate crude oil just absolutely plummeted. It wasn't that long ago that this was above $90 and $100. We're now plummeted to 45, recovered to just over 50, and it's just been up and down and all over the place, and finished the week at $49. The fallout from such a massive move in energy is just going to be absolutely massive, and it's going to be absolutely unpredictable. There'll be things unfold in the next 3-4 months that we can't envisage at this point in time, and they could be very, very significant. And I'm talking things like a Russian bond default. Venezuela is in trouble. There's a lot of oil producing countries that are in trouble, and no one knows how that's all going to play out. Now, there is now some great value in some of the high quality energy stocks, but it's still too early to buy into energy stocks. You look at the gold market. The gold market was down. We've been in a gold bear market for 3 years. I'm not saying that'll be the case with energy, but after only 6 months, it's far too early. The move has been too big. It's far too early. So just forget about trying to pick the bottom in energy stocks at the moment, even though there's lots of commentators out there that are trying to do it. You don't get huge moves like this and then it's all over and everything goes back to normal within a period of 6 months. This is going to take quite some time to play out. There's the copper chart. You can see that we declined just under the $3 mark, hung around there for about 6 or 7 weeks, had a bit of a steady decline down to 280, and then it just completely let go. And it's certainly been a major move. So just to wrap it up, the overall strategic approach, the US stock market is still the most reliable growth market. You can raise your odds even more by staying just with the best sectors, which are biotech and digital tech. There's some rubbish in those sectors, so you don't want to just buy anything. You want to stick with the very best of those biotechnology and digital technology stocks. There are also some opportunities in India. I think India is interesting as a place to potentially invest, and also some parts of Asia as well. The best way to do that, if you're trading an American broking account is via some of the exchange traded funds that they've got in America. But other than that, I would advise, with the exception of gold, I would advise avoiding commodity stocks and especially resource service companies. This is not a cyclical situation that's going to change in the next 6 months. I believe what we've seen in energy, copper, iron ore, coal, uranium is a major turning point, and I don't think we're going to get back to anything like what we would consider normality with commodities for probably at least a decade. I think this is a long-term situation that we're in. So that's the wrap up of what's been an absolutely amazing 2 or 3 weeks in all commodity and currency and stock markets. Volatility brings opportunity. That's the good news. But volatility also brings the opportunity to make mistakes and get things horribly fouled up. So you need to be very clear about what you're doing. You need to be patient. You need to be disciplined. If anyone wants some help with any of that, then there's my email address. I'm always happy to communicate with people who are genuine about improving their skills and improving their performance. That's it for this week. Talk to you again. Cheers.